So what's good, everyone, and welcome to the Financial Four channel. And today we are going to talk about taxes. Now, there's a lot we can talk about. There's the topic of should taxes exist? How fair are taxes, especially in states like Oregon? Well, these brothers is paying 71% state income tax. RIP Damian Lillard. But there's the topic of Jeff Bezos, he's worth 200 billion and doesn't pay a dime in taxes. There's a lot we could talk about, but what we do want to discuss today is the upcoming tax season, some of the things that you can qualify for. Maybe there's things that you've been missing out on, like myself, that you don't even know about, and also how you can maximize this upcoming tax season, whether you're single, you have a family, you're a college student, and or have a small business. So buckle up, hands and feet out the ride at all times. We got lots to talk about. If you ask a lot of people, what taxes are or what the purpose of them are, what the purpose of tax refunds are, you will get a lot of mixed answers. I asked this one guy, I said, hey, what's the purpose of a tax refund? But he went, oh, the government, they're just rewarding our hard labor. He lost, boy. He lost. I hate to say it, he lost, but when you look it up on Google, taxes themselves are mandatory payments owed to federal, state, and local governments to fund their expenditures. So it's like the automatic payment to the government for protection, like military protection, healthcare, even schooling. That's a big one. Then also to grow the economy, spread our wings a little bit. So that's what taxes are. Then there's also, different types of taxes. There's sales tax, property tax, then there's income tax, which, we'll talk about today. DJ, you got anything to add to that?
Not too much. You really covered it pretty well. All I have is that, they're just taxes or funds collected from individuals. And that money is usually used, to, help fund public spending or, government things, fixing up, public use stuff. Yeah. So that kind of thing. So, really it's kind of the same stuff that you said. And, yeah.
Awesome, awesome. Yeah, so that's what taxes are. Now we can kind of move into tax refund. So a tax refund um, is often, it means that you made a mistake on your taxes. Uh, this definition here, tax refunds often mean that you made a mistake by paying more income tax than was necessary. Federal or state governments will refund the excess money that you paid out to them. You can avoid overpaying by filling out employee tax forms correctly and estimating or updating deductions with greater accuracy. So my biggest thing, DJ, is like, do you trust the IRS to give your money back? You know what I mean? Because they be a lot. Like when it comes to tax deductions and stuff, they hush hush on that, bro. Like if you don't do the tax deduction or tax credit or exclusion or whatever, they ain't gonna say
Yeah,
nothing.
if you don't do your research, they gonna get you. They gonna get it's like, give me that. Yes, please.
Yeah, right. I'm sure there's ways that you can calculate your W-2s and W-4s. Maybe you got a 1099, whatever it may be. But man, I just feel like have have they cut me short on some money? Have they scalped me a little bit? You know what I mean? But yeah, that's what a tax refund is. Anything you want to add to that?
You cover it pretty well. It's just, my biggest thing is that, yeah, it's usually, mistakes that you made on your form. So it's really not a good thing to be getting your tax refunds. A lot of people on social media, oh, tax refunds about to come and every year, and they hype. And it's like, that just means y'all making mistakes, boy. Y'all making mistakes.
That's all it really means. But like I can see people also like they like that feeling of that money coming. You know what I mean? Like,
Mm,
'cause, I like that feeling too. Um, you just got 2 grand dropped on you. Even though you technically made a mistake, it kind of feels good that. So I can see how people could They
Oh,
would
they
be cool with
start
that.
licking their chops, boy. That
Boy, I
taxes
can't
is
wait to
coming
make more
up.
mistakes, boy. More mistakes.
Gotta
But
change. Gotta fix that, boy.
right. So so DJ, I know you're I know you're a college student right now, and one of the big things that I realized way too late, being out of college, a couple years now, is that I missed out on a lot of tax deductions, credits, exclusions, whatever you want to call it. There's a lot of money that I can't get no more, and I ain't gonna lie, I can use it, bro. I can use it, but so any tax deductions for college students, you know?
Yeah, yeah, there's a couple that I have here today. There have been a few more that I've seen on social media and throughout doing some research and whatnot. So it sounds like there's a lot more than just these two and what you can do and kind of try and get your hands on. But what I have for today is two main ones that I saw: the American Opportunity Tax Credit and the Lifetime Learning Credit. And these are two tax breaks that I saw doing some research for the American Opportunity Tax Credit. They also abbreviate it as the AOTC. It provides a maximum of 2,500 annual for eligible students within their first 4 years. And to qualify for that, you have to be pursuing a post-secondary degree or any other recognized educational credential and be enrolled at least half the time for one academic term at the beginning of that tax year. Um, and then, just something else with that I saw is that the amount of the credit is equal to 100% of the first $2,000 on your qualified educational experience expenses. So if your qualifying educational expenses are, $4,000 for an example, you would uh, be only allowed the maximum credit of 2,500. So that, but that's something I found for that, and it's a tax break, that I found, and I think that would be very beneficial for a lot of these students. I mean, I'd love to have a maximum of 2,500, so
Right. Tell them to
just stuff
bring me
like
my
that.
money, boy.
Exactly,
Please
exactly.
bring me my money.
The second one, lifetime learning credit that I found was they also call that LLC. They abbreviate it as LLC. And this credit is for qualified tuition related expenses paid for eligible students attending qualifying schools. And unlike the AOTC, there is no limit on the number of years you can claim the credit. So, in addition to that, you also don't have to be pursuing a degree or be enrolled at least half the time. So that's I know it's going to be beneficial for a lot of other people as well. And it's non-refundable, meaning you can't receive any of the credit back as a refund as you can with the AOTC. And the amount provided by the LLC equals 20% of the first 10,000 of qualified education expenses, or a maximum of 2,000 per tax return. You can only claim the credit if you're modified adjustment gross income. So if you make more than if you can only claim it if you make less than 69,000 per year. So and that's like as a joint household, whether you got a family or by yourself. Yeah. So as long as it's below 69,000, you can claim that.
That's dope, bro. That's dope. So like I found by the way, we'll drop all this info in the description down below. Like any links you want to check out, we'll drop them down below. But I found there's a couple things like this is straight from the IRS website. So if you run into any issues, be like, nah, bro, the IRS said this. You know what I mean? So like this is straight from the source right here. I mean, they got a whole education information center um where they go through different education credits, different education deductions. There's tuition fees deductions, student loan interest deductions. Uh, they go through if you qualify for it, how you qualify for it. education required by an employer or by the law. They even got savings plans up in here. They got everything that I didn't do. Everything, boy. They got everything. And so uh, we highly, highly encourage all of our viewers to do your own research as well. Check this stuff out, especially if you're a college student, you're gonna need this. Or if you have student loans, right? You can get some of this money back that you've been paying on. So um, please, please, please do your own in-depth research. All right. So now we're going to go through some of the tax qualifications that you can qualify for. There's several, whether you're single, you have a family, or you're a college student, a couple of these do apply to college students as well. So one of the things that you can qualify for is the 401k and 403b tax deduction. It says here that you can take a portion of your paycheck and put it into your retirement account, such as the 401k and 403b. 401k is for people that are at a for-profit company. A 403b is for people that work at a governmental job or a nonprofit organization. So when you put your money into a retirement account, it decreases your taxable income, having the same effect as a tax deduction. There are noticeable pros and cons to these, which you can research in depth. Back in 2022, you could opt in to put away $20,500 plus an additional $6,500 if you're over 50 years old. Then there's the traditional IRA retirement account. So you'll typically put away retirement money through your 401k or 403b. But if you want to put away more money, you can put money into an IRA. Depending on your income, spousal situation, or whether you get offered a retirement plan at work, it says you may be entitled for more tax deductions for putting money into your IRA. So that's something to think about. Then there's the FSA, the flexible spending outcome. So if you do not have a high deductible health plan, you can opt in to go for an FSA on your medical expenses. With an FSA, you can use pre-tax money to pay for your medical expenses, but you need to watch out because there is a use it or lose it rule where if you don't use all the money on your FSA by the end of the year, you're going to end up losing it. So unless your company has a rollover option, um, you may need to do a FSA. You may need to use the money in the FSA. In general, if you are young and healthy with few prescriptions and medical conditions, then you're better off with the HSA. The HSA, the health savings account, is a savings account for health-related expenses like the FSA. But when you put your money into your HSA, you get a tax deduction, and it gets built into your W-2 that you're going to do through your work. If you use the money in your HSA for qualified medical expenses, then you're not going to pay taxes on that money. On top of that, you can invest the money in the HSA, and the earnings and the interest will grow tax-free. However, HSA is mainly for people with a high deductible health plan. There's the Dependent Care FSA. This one goes mainly for families where you can pay for your childcare expenses with pre-tax dollars. You can do this for your children, adult dependents that are unable to care for themselves, where you can use pre-tax money to pay for daycare, preschool, nurseries, after-school programs, nannies, babysitters, day camps, adult daycare facilities. Whatever you need, they got it. They like that dude on the corner of the street. He got incense, oils, Blu-rays, DVDs, whatever you need. He got it.
Whatever you need, boy.
So then there's the pre-tax commuter benefits. So you can spend up $300 a month tax-free on commuting to work. So this is basically a $300 a month tax deductible every month. Commuter benefits allow you to pay for your commuter expenses with pre-tax dollars, which applies to mass transits like trains, subways, buses, ride sharings, if you do like Uber or Lyft, parking meters, parking garages, parking lots, it applies to all that. So this gets adjusted each year for inflation. Now, for if you do stock investments, you need to listen to this. So there's something called the tax loss harvesting. So at the end of the year, you can sell your losing positions in the stock market in order to claim the losses as a tax deduction. All you have to do is not repurchase the same stock within 30 days. Otherwise, you're not going to be able to claim that tax deduction, which is known as the wash sale rule. And there is a $3,000 deduction limit, right? You can deduct capital losses on crypto. And so you can report them as they are tax deductions, and you can utilize your crypto losses to offset your capital gains in the stock market or offset your ordinary income, vice versa. And DJ, I think you have some on like NFT type stuff or crypto on that.
Just I have a couple of things just about how those are taxed in general. I think there might be some confusion about that, or maybe some people don't know exactly what the deal is with that. And I'll just say NFTs are considered digital assets, which are similar to crypto, which is subject to capital gains and ordinary income tax. And they are taxed through buying, selling, and trading through cryptocurrency, and also through buying through fiat, transferring through wallets, and donating. Um, and yeah, fiat, just for anybody who isn't familiar, is just government issued currency that is not backed by a physical commodity, such as gold or silver, but rather by the government that issued it. So, for those who, because I said fiat on there, so there's a little quick definition for that. The tax rates on NFTs kind of depends on the sell date. So, short and long-term capital gains, as well as personal income tax bracket, which is usually ranging between 10 and 37%. And NFTs could also be considered a collectible, which is subject to only to a max of 28% tax rate. And yeah, holding long term. So with these NFTs, dispose in a low income year, and you buy with fiat versus crypto, and tax loss harvesting can be ways to lower tax costs on NFTs. And then just something else that people, I know, big thing in the NFT world is gas fees. And these, I don't believe these are necessarily affected by taxes and whatnot. But those are always going to be there, and they always add or subtract to the cost as well. So those are just a couple things, a couple notes that I found, through do some research about, what is in taxes, or what is taxed on NFTs, and what are they really designated as, some of the different ranges of, yeah.
Dope, dope. Yeah. So if you into NFTs, crypto, Bitcoin or whatever, that's definitely something to consider. So there's also something called the 475F election. So if you have more than $3,000 in stock losses from day trading, you can opt in for the 475F election. It only qualifies for day traders, not stock investors. Okay. So if you end up qualifying, remember that this is for big losses, not big gains. Okay. So if you have had, a bunch of, successful day trading, this ain't for you. Okay. So because what's going to end up happening is that the Fed, they will tax you an extra 17% of your trades if you do your stock tax form through the 475F election, right? So this election, it must be made by March 15th. No ifs, ands, or buts. Um, please, please, please do your own thorough research on this, okay? Um, so there's long-term capital gains as well. If you hold onto a stock or crypto for over a year and sell it for a gain, that's a long-term capital gain where you will receive much better tax treatments compared to selling in under a year. With the long-term capital gains, you pay roughly half the tax rate compared to the ordinary or short-term capital gains. There's also a 0% long-term capital gains tax rate if you are single and like DJ said, you make under, uh, I believe now it's 69 grand, DJ.
Yeah, 69
Yeah,
great. Yeah.
yeah, and so you can basically kind of double that. And if you are married, then your long-term capital gains will be free if you're under what 120K, somewhere around there. Um, so and again, it'll be tax free. So you basically just made free money from without being taxed, right? By the way, this is purely for federal taxes, not state taxes. Okay. Now, for my experienced stock traders out there, you can take out a loan against your stock assets. So let's say you have $10,000 in stocks, but you want to take out, say, 35% of that without selling your position. Because, I mean, remember, if you do sell your position in under a year, you're going to have to tax. What you can do is you can put that portfolio up for collateral to borrow that 35% of your portfolio value, which in this case would be like 3,500 from that 10 grand. And you will not have to pay taxes because this is a loan. But you would have to pay back the borrowed money with interest depending on the value of your portfolio asset. Typically, though, this interest rate is lower than others that you're used to, like a mortgage rate or whatever, um, or other interest rates on loans. Often, experienced stock traders can use this money to make more money than the interest charged from the loan. Example, the interest rate may charge 3%, but you're investing at an 8% return, and so you'll make that money back, a lot faster. Um, Again, this is only for my experienced stock traders. If you know what you're doing in the stock market, this is for you. Get on this, bro. I'm telling you. Um, and then it's just investment interest. So don't forget to deduct your margin interest. This will be listed on your 1099-B tax document from your brokerage. You can deduct your investment interest expense for stocks and cryptos. Other plans that you can utilize, DJ mentioned this, 529 plan. Families can use the 529 plan for your child's education or your own education or anybody else's education. You will not receive a federal tax deduction for putting money into the 529 plan, but you could receive a state tax deduction. Some states will not offer you a state income tax reduction for putting money into the 529, but even still, you will receive tax-free growth and tax-free compounding growth. But if you can put away money for you or your child's, education and get a state income tax deduction, that's something you should do. General tax deductions and tax credits, don't forget to look at your tax deductions and tax credits to lower your taxable income. These can be charitable donations, earned income tax credit, there's student loan interest, there's mortgage interest, there's property taxes, there's the PMI, there's, if you got an electric vehicle, you can get tax credits on that. There's all types of stuff. So please, again, do your own research. So just do your own. There's so many things out there that we could spend 2 hours just. We ain't got time, bro. The Super Bowl about to come on in the hour. we ain't got time for all that. But please again, do your research. Please, that's very important, and it's very important because what I've been taught is that you learn more from doing your own research than from just squarely listening to somebody. You can find a lot more out, and that's just a principle of life. So um, that is going to conclude our video for today. Let us know down in the comment sections, any questions, concerns, anything that we can help you all with. Unfortunately, a couple of our brothers weren't able to make it today, but that's all right. We appreciate y'all for tuning in. Like and hit that subscribe button for more content. And we love y'all. Yours truly, Financial Foe.
Take it easy.
Yes, sir.